Hello, I'm Mark Simpson, and I'm continuing my online talks on themes from investing. This one is particularly close to my heart, being as it's to do with deep value investing. At the moment, we find ourselves in a time of crisis. The coronavirus is going across the globe and costing many lives, and I don't want to brush over the human tragedy that this is causing, but at the same time, I want to recognise that in investing, sometimes crises also give opportunity, and I think that this could be one of those times. So I'm going to do this talk in two parts, unlike the other ones, because I think this is going to go a little bit longer than usual. And at the start, I'm going to look at what is value investing. So I'm going to look at a short history of value investing and look how we got from Benjamin Graham, the father of value investing, through to what I'm calling modern deep value investing. Then in part two, then I'm going to look at applying that deep value investing to opportunities in the UK stock market today. Let's go straight in. So value investing has quite a long history. And as I said, Benjamin Graham, pictured here, is often considered the father of value investing. He wrote two books. The first is Security Analysis, which he wrote with David Dodd, and later probably his most famous book, The Intelligent Investor. And what Ben Graham did, which was unique for the time, was that he separated investment from speculation. So he introduced the concept of margin of safety, that an investment is one that had a large margin of safety and had a positive expected outcome over time. Whereas a speculator was somebody who simply thought a stock price would go up or down and didn't consider fundamental factors such as valuation. To help us understand this, he introduced the concept of Mr. Market. So this is the schizophrenic partner in your investing pursuit. Some days he's euphoric and he will offer you a very good price for a stock. Other days he's depressive and will not want your stock at almost any price and offers you a large discount to buy. Benjamin Graham said that we should take advantage of Mr. Market. We should be selling when he's euphoric and we should be buying when he's depressive. And he introduced concepts such as buying stocks that traded at a large discount to their tangible book value. And not only was Graham himself a very successful investor using these methods, but he also formed what Warren Buffett later called Graham and Doddsville. So those are other successful investors that followed in Ben Graham's footsteps and used the similar sort of techniques to be successful investors themselves. So examples are Walter Schloss, Irving Kahn, and Christopher Brown. Another disciple of Ben Graham was actually Warren Buffett. So he studied under Graham at Columbia before going to work for him at his Graham-Newman partnership that he ran at the time. And it was quite hard for Buffett actually to get in to work with Graham. He actually offered to work for free in the end. That was how much he valued the input of Benjamin Graham. However, over time, although Buffett in his original Buffett Partnership Limited used to use very much the Graham method, sometimes called cigar butt stocks that have one puff left, but you're getting them very, very cheaply. The example was you find them on the ground. But over time, and particularly as Warren Buffett's assets under management grew, he became much more interested in looking at great businesses at a fair price. And this is also at the encouragement of one Charlie Munger, his longtime business partner. They haven't written books themselves, but you see here there's a very good biography of Warren Buffett by Astroda, and also a book called Poor Charlie's Almanac, which gives great insight into Charlie Munger's way of operating. And the way they operate is to look for what's called wide economic moats. Examples are things like Coca-Cola or American Express, where it's very hard for competitors to crowd in on those businesses and take their business. You may want to watch my one of my other talks if you're interested in learning a bit more about competitive advantage. In the talk, the three biggest mistakes even smart investors make, you see that I cover some of those concepts. And because of that, Buffett and Munger lately focus less on tangible assets, although they still like the margin of safety and a conservative price. They very much focus on things like brands and competitive advantages, and less on the tangible assets that an investor is getting. And continuing on our history, the Buffett and Graham are very much qualitative investors. They look at the quality of the stocks that they're getting, whereas approaching the kind of 70s and 80s, value investors started to be able to use computers to look for anomalies, and people started to find that low price earnings or low price to cash flow outperformed the indices over the long term. And people such as Jim O'Shaughnessy here or David Dreman, sometimes called quants because they use a quantitative approach rather than a qualitative approach, started to invest in that way and started funds where they had a basket approach. They bought the quintile or the decile stocks that appeared best on their metrics, and they also sometimes shorted the bottom decile, so what the model would say would be the worst performing stocks in their universe, and that could give them market neutral returns. And you still get quants in the market today, although they often don't just look at value as an anomaly, but they look for momentum, quality, low volatility. There's lots of things, anomalies that have been found, and quants use those to try and beat the market today. Back to a more qualitative approach. So a guy called Joel Greenblatt in the 80s and 90s produced a phenomenal return, 45% compound for 19 years. If you just do the maths on what that generates overall, that is just a phenomenal return. And he did it by saying investors should focus where other investors are selling for reasons that are not related to the fundamental value of a stock. Examples would be spin-off investing, and he wrote a very good book called You Can Be a Stock Market Genius, where he takes people through the mechanism of being a spin-off investor. But he very much focused on the importance of good valuation work. So Greenblatt also taught a special situations investing class at Columbia, and as part of that, he very much says that investors need to be able to do good valuation work to be good at value investing. On the heels of Greenblatt and special situations, then you started to get investors who really took concentrated investments. They very much looked for low risk and high reward. And here I've got a couple of examples: Monish Pabrai and Guy Spier. I've called them the Buffett disciples because they famously paid for to attend a lunch with Warren Buffett, and they very much took on board the principles of that Warren Buffett teaches in their investing style. They are very patient investors like Buffett. They're very keen to wait for the perfect pitch. One of Buffett's sayings is that investing is a no-called strike game. You don't have to swing at every investment, but you can wait for when the perfect time comes or the perfect investment comes. And both Monish and Guy are very good at building their life around being optimal decision makers. So, for example, Pabrai has a bed in his office, so he can take an afternoon nap. So he very much recognises that his mental capacity is the key to good investment decisions, and he needs to be as alert as possible to make those decisions. Guy Spier as well has a reading room in his office where there's no computer, there's no Bloomberg terminal, and he aims to spend most of his time reading and researching stocks in that quiet and reserved atmosphere, rather than watching the daily ups and downs of individual stocks. And as we go on, there's some value investors that again quite famous and again hold concentrate positions, and unlike Pabrai and Spier, these guys are willing to go short as well. When they see extreme overvaluation, they're very willing to short stocks, and they're also activist investors. So David Einhorn wrote a book called Fooling Some of the People All of the Time, and was about a short position that he had on of a housing company that appeared to be making up the numbers or not reporting honestly. But his battle went on for a long time, long enough for him to write a book about the saga. Bill Ackman, the other famous sort of activist manager, took a position against a company called Herbalife and did a very long presentation about why he thought this business wasn't a great business. So they very much want the publicity. If they think a company is poorly performing or has had bad behaviour, then they're very willing to publicly declare that. But both have faced difficult periods. I think maybe they're sometimes too crusading. They get too involved with their short positions, and lose an independent perspective on some of their stock picks. But both are phenomenal analysts, and they generate very good returns by just being better analysts than the market, and willing to hold those concentrated positions for a long time. And continuing on, I want to bring us full circle. So Benjamin Graham started off talking about deep value investing, using accounting metrics instead of competitive analysis, looking for those cigar butt stocks and waiting for the right conditions. And there's a few investors here who follow the same principles. So Jerome Boss wrote a book called Deep Value Investing, about applying Graham's principles in the modern UK market. Paul W. Allen, an accounting professor as well, has written a very good book called Choose Stocks Wisely, that follows a similar sort of method with a focus on financial strength and not taking losses, as well as generating good returns. And finally, Toby Carlyle is a great investor and an all-round great bloke as well. I was on his podcast recently, and he's written a book called Deep Value that again looks at buying the cheapest stocks in the market and how you get a greater return. Interestingly, the all three investors shun the use of competitive analysis, and another investor, hedge fund manager called Dan Rasmussen, has written a really good paper about how applying Porter's 5 forces model actually leads to poorer investment decisions and corporate decisions being made. So I think very much there's a lot going for this deep value method, and the issue is often not the performance of this, that it's often the scale that you can deploy capital into, and I think that's one of the reasons that Buffett became less of a Graham deep value investor and more of a Charlie Munger quality investor, is because the scale of his assets under management mean he could no longer get those cigar butt investments. So unfortunately, despite all this storied history of value investing, successful value investing, then actually people are asking the question today, is value investing dead? So price to book, which is the classic metric that academics have often used to define value stocks versus growth stocks, has underperformed the market, or certainly underperformed growth stocks for at least 10 years, maybe even 30 years, looking at this chart here from top-down charts, with a few exceptions, a few bounces back. It appears that price to book investing hasn't really performed for investors for what is an investing lifetime for most of us, and in fact it doesn't seem to be getting any better. So you see here on this chart that Q1 2020, what we're going into as what we're going out of as I'm recording this talk, it was one of the worst quarters ever for price to book. So maybe despite all that history and those successful investors, maybe value investing is dead. Maybe the world has moved on and these things don't work. Well, I can offer you a partial resurrection here. So there's a number of issues with using price to book as your value metric. So for example, it doesn't really include debt. So you price itself doesn't account for the capital structure of the underlying company. So a company could have a low price to book but be heavily indebted and financially quite weak. The other thing it does is it often misses high cash flow but negative book value stocks. So things like McDonald's or Domino's Pizza. So these generate a lot of cash, but because of buybacks and the way that GAAP or IFRS accounting rules work, these stocks often end up with negative book value. Yet they're successful companies that generate cash and often can be quite cheaply rated at times. Finally, the GAAP and the IFRS book value measure often understates both long-term assets and intangible assets. And you find that often intangibles are now a greater part of the value of companies. And unless intangibles are capitalized, then those don't appear in book value. And often other value investors will exclude intangibles from their analysis. So what's the resurrection? Well, the resurrection is that cash flow or EBIT or EBITDA measures often have performed much better than price to book value, certainly over the last 30 years. Also, it's useful to use enterprise value, so including the debt or the cash that's on the balance sheet. So that gives a more market structure or capital structure neutral look at the performance. And here's a chart from Toby Carlisle, who is the value investor that we met in the last section, and he's showing price to cash flow, value versus glamour or growth decile relative performance. So here you see that over the last 30, or I think it's even 50 years, that or 70 years, that values perform much better. But if you look carefully, at the very last period, price to cash flow has not actually, or the value part has not outperformed the growth. So you see that that large drawdown at the end of the chart represents the biggest drawdown between the performance of value and growth on price to cash flow measures. And the question is this a structural market change? Again, has is value investing dead, or is this a growth bubble, or central bank actions have clouded things? Do we actually have the resurrection of value anomaly or not? And to look at that, I give you a tale of three charts. So the first chart is from an article by Alpha Architect, who are a quantitative investment fund. So they're one of the modern quants. And here it shows the price to cash flow multiples of value stocks in orange. So that's the place where the multiples stay pretty much consistent over time. Yet for growth stocks, the price to cash flow multiples has massively increased over time, and particularly in the latter part of this bull market, which suggests that it's valuation that's driving growth stocks. So the market is placing a greater price on growth stocks than value stocks, and that means the market is expecting growth stocks to grow much faster, much faster than they have in the past. Yet this is where we come to the second chart. So this is from O'Shaughnessy Asset Management, and they're showing the earnings per share movement of value stocks versus an equal weight market. And here you see that over time, the equal weight market has a fairly steady growth. I think they're looking at a period 1992 to 2002 on this graph. The value, however, drops down initially, so the earnings are actually falling. So this is why potentially these stocks are value stocks. But after maybe 24 or 36 months, you see that the value stocks have returned back to the average growth rate of the market. So what you're getting from the value stocks is the same level of earnings per share growth, and therefore what should be the same level of multiple that you would apply, the forward multiple you would apply if all things were equal to those earnings, but you're paying much less. So this, and because the market's forward looking as well, you actually see that the price earnings, or the rating of value stocks, actually improves before the earnings start to improve. So the market starts to, after about a year of the falling earnings, as soon as the earnings plateau and start to very slightly go up, the market sees that and sees the forward performance of those stocks and gives them a higher rating. And this is what we see in the third chart, which is the price earnings, and it shows how a set of value stocks that are rebalanced every year generates its return. So each time you get a yearly rebalancing, then you see that the price earnings of the stock increases and generates returns for investors as the market starts to anticipate that those earnings have troughed and are coming back to the market average. Then the price earnings starts to go back up to the market average, and this is the sawtooth wave that you see here. And the down arrows are the portfolio being rebalanced. So after 1 year, selling the value stocks that have increased in price earnings, have gone up in price, and buying a new set of cheap stocks that are low on price earnings and are going to start that process of mean reversion. So this explains how in the past the value stocks have outperformed, and I don't see a reason why that mechanism is going to go away. I don't, there's no evidence that we're seeing a permanently higher growth trajectory for the earnings of growth or glamour stocks versus value stocks, and the reason comes back to capitalism. The stocks that are doing badly face a mean reversion. They're under pressure. The managements are under pressure to reduce inventory, to develop better products, to improve the sales force, to shut down unprofitable divisions, to return assets to shareholders. All of those things mean that unless capitalism is dead, I believe that value investing will come back at some time. However, despite the long-term outlook for value investing being not as bad as everybody says, we have some major problems in today's markets. So you see that all of these value measures and the success of kind of later value investors of using earnings as the positive driver of their returns has gone. So earnings and cash flow are potentially going to be zero. Well, in some cases, revenue is going to be zero in today's markets because a lot of sectors of the economy have been shut down to prevent deaths under the COVID-19 virus. And a lot of companies are therefore scaling back or completely cutting their dividends and their buybacks. So measures such as shareholder yield, which is where you value a stock on the amount of dividends and buybacks it's paying out to shareholders, a lot of those stocks will simply go to zero. So previous stocks that appeared cheap and were paying out high dividends and had high buyback rates suddenly look like the worst of stocks on that value measure because they have no dividend and no buybacks. But maybe we can think about the forward earnings potential, and we can skip the fact that in the short term we're going to face some serious problems with earnings, dividends and buybacks. Well, that would be great, but all of the broker forecasts are being removed. Nobody really knows what the outcome of certainly the short-term outcome of this virus are going to be on the markets and on individual stocks. So therefore, brokers are simply removing their forecasts. And as are companies themselves, you see lots of companies saying, we just don't know what the future is going to hold. And for here, I've seen we have this Danish proverb, which is, it's difficult to make predictions, and especially about the future. And that is even worse in the current times because the uncertainty levels are so high. So maybe we should be doing what Buffett's doing and buying the compounders. I suspect there's reasons the compounders may still be overvalued. The market hasn't dropped that far, and many people have sort of fled to quality, what they consider quality stocks. But those are stocks often that have growth forecasts, even in good years, even before this crisis, they had growth forecasts of maybe 5% sales, yet they were trading on 30 to 40 times earnings because people thought they were quality, stable stocks, and that they had high returns on capital. But if you're generating no growth, then that high return on capital doesn't do any good. You only have to do the maths on those sort of things to show that the point of a compounder is that it actually generates higher than average growth rates over the long term because it can compound its capital more readily than other stocks. So that sort of kicks out another leg of our stool. So maybe we can rely on tangible book value. So maybe we go back to the oldest Graham or one of the oldest Graham tactics of looking at tangible book value. Well, this is an issue as well because this is changing rapidly. If your company has maybe freehold property on its books, then normally that's considered a very safe asset and something that has significant value. However, with commercial REITs, real estate investment trusts, are trading in some cases maybe 50 or 60% discount to their net asset value. That means that maybe that commercial property that you thought was secure on a balance sheet is actually worth only 50 or 60% of the value that it was before this crisis. So that knocks the final leg out of our valuation. So even if you're a value investor in the current markets, there's a lot to lose, a lot to ponder, and there's great uncertainty. But I think there are opportunities, and they go back to one of the oldest ways that Benjamin Graham used to invest, and that was called net nets. So in the next part of this talk, I'm going to talk about those net nets. I'm going to define them, and I'm going to look for these deep value opportunities in the UK stock market today by looking at some very specific companies and applying that process to those companies. But I'm going to save that for the second part of this talk. A quick reminder, I've got a book out and check out my other investing videos for some flavors about what that's about. It isn't, although it applies to deep value investors, it's not just for deep value investors, and it will give you some great insights into to how to build a better portfolio for your stock picks. Finally, do check out the second part of this series while I look at those Graham net nets and the specific stocks that are coming up on my screener at the moment. Please check out my website as well if you want other book recommendations. A lot of the value investors books that I've shown in this presentation are on that recommended reading list. Any questions, email me or follow me on Twitter. Catch you for part 2 soon.